Coming up on the SBS On The Money podcast today, we speak with the CEO of the A2 Milk Company, David Bortolussi, and we preview tomorrow's Reserve Bank interest rate decision. Will it cut? All those details next. Hi everyone, it is your daily 10-minute business and finance news wrap for this Monday, the 17th of February 2025. The Australian share market fell today. We'll have the details with Luke McMillan a little later from Ophir Asset Management and our extended interview with the CEO of A2 Milk. But first, the Reserve Bank Board met today for the first day of its two-day board meeting. Will it cut interest rates tomorrow for the first time since November 2020? I spoke with David Bassanese, the chief economist at Betashares. So David, you think the RBA can cut as much as 35 basis points tomorrow? Why?
Well, I think a rate cut is definitely warranted, and probably when they're thinking about cutting rates, they're thinking about at least more than one. So I think, and we've had this odd historical anomaly of the last few years where, if you think back to COVID, they actually cut rates at one point by 10 basis points because they were near the zero bound and they didn't want to cut the cash rate to zero. So they only cut by 15 basis points to get it to 0.1%. So ever since, they've been moving in quarter point movements, and we've had this odd, rounding of the cash rate. And historically, it's been around a quarter of a point, 4.25 or 4. So I just think get it back to a nice round number, provide a generous cut of somewhat more than 25 points, and they can, maybe reduce the need to cut rates again quickly within the next few months.
Yeah, so that's a good point. At that level, though, if you go at 35, to what extent does it negate the need to give further rate cuts, and why?
Yeah, basically the RBA, I think, is now on a path to moving interest rates back to more normal levels, less restrictive levels, which is probably around 2.5%, 3%. Now, they don't need to get there immediately. They'll move there gradually. So the more they do now, the less they'll feel less pressure to do anything quickly again soon. But it doesn't mean they won't eventually cut rates. If inflation does come back into the band over the next 6 to 12 months, interest rates should continue to be cut till we get back to a more neutral level of the cash rate.
But there's still no guarantee of a cut tomorrow, right? If the RBA does hold, why do you think they'll do so?
Well, firstly, I'd be very disappointed if they didn't cut interest rates. But if they did, I think it'd be, the labour market is certainly still pretty strong. We're punching out pretty solid employment gains. The unemployment rate is low. There might be a fear that if they did cut interest rates, it might quickly spark, an uptick in wages pressures, and the service sector side of inflation is still somewhat sticky. So it's but again, not everything needs to be in target. They're targeting the average inflation rate. The average inflation rate has been coming down. There's certain parts of the economy that usually always run at a higher rate of inflation, offset by lower rates of inflation in areas like the goods sector. So, but that would be the reason, just concerned that they might spark an untoward rebound in inflation. But they've promised that they would cut rates as we got confidence that inflation comes back to the band, not that it needs to be, or back in the band before they act.
What about the global experience? The US, for example, inflation has re-accelerated there. The Federal Reserve has cut interest rates by 100 basis points at the back end of the year. Is there a fear that could happen here too?
Look, there's always a risk to doing anything. The risk of not cutting interest rates is that consumers really lose a lot of hope and we get a slump in the economy. So there are risks in not cutting interest rates as well. The risk in cutting rates is, as you said, that if the decline in inflation that we've seen stops and reverses. In the US, it's certainly ticked up a little bit, but I think in the main in the US, it certainly stopped falling through last year. And because of the stickiness of the services sector. But the US economy also has been a lot stronger than the Australian economy. GDP growth has been at trend or better, whereas in Australia it's been quite weak. So they're in a different situation.
to our CEO series, where we speak with the CEO of the A2 Milk Company, David Bartolussi. The company posted a $91.7 million half-year profit. That's a rise of 7.6%, and declared its first ever dividend. What does it say about the company, and what about its challenges in China and tariffs? Rhayna Bosch spoke with CEO David Bortolussi.
We're delighted to be able to report earnings growth of 7.5%. Our sales growth was 10% for the period, which is terrific and ahead of our expectations, the top end of our guidance. In terms of our outlook for the full year, which we updated today, we've guided to low to mid double-digit growth in the top line, and with a slight improvement in our EBITDA margins, which is very pleasing because we've incurred significant one-off costs this year in coping with some supply shortages that we had in the first half, and also some accelerated depreciation of one of our assets. So we're really pleased about that. So the main driver of that in terms of the upgrade is a recovery in the English label cross-border infant market into China, as well as improvements in our position within that, and also our liquid milk business, particularly in the US.
Now, David, I'm glad you brought up China there, because I do want to kind of delve into that a little bit. Obviously, you are a top 5 player in that market. Can you tell us a little bit in terms of what you're seeing from the consumer there at the moment?
The macroeconomic conditions are quite challenging, as they are in many markets around the world. In our category, we've had declines in the birth rate over a number of years, which is together with competitive pressures and a change in a lot of product in the market, which the standards changed and a lot of product had to be phased out and phased in. So all this has caused a lot of turmoil over the last couple of years. And so the market has been in pretty significant decline. So this period, we've seen it improve. Last year in FY24, it was down over 10%. In this half, it was down 6%. And more recently, the last quarter was down 4%. So we're starting to see a stabilisation in the birth rate. And actually, the birth rate was up a little bit last year. But despite all that, with the market being down 6%, we managed to grow our sales 7% in infant, which is terrific.
Another pertinent point is tariffs, US tariffs that are coming into play at the moment. How does that affect your company?
Not much directly. So the only direct impact we may have at the moment is in our US business. We import some carton and other products from Canada into the US. That's relatively immaterial in the scheme of things at the group level. In terms of China and New Zealand and Australia, at the moment we don't see any direct impact there, but we're mindful of potential indirect impacts over time. We're hoping to develop our infant business over time from New Zealand into the US. There's already a tariff structure in place for that. Hopefully that won't change materially going forward, because we'd really like to realise that opportunity.
Now, we've talked a little bit about A2 Milk's growth outlook. Where do you see the opportunity, the real opportunity for growth at the moment, and in which markets?
Well, we are very focused on the China market opportunity. I know that many investors are concerned about geopolitical risks and the category for us in China, but we still have a very small share of a very large market in China. The China infant formula market is worth about $25 billion at retail, and we only have a 7.7% share of that market at the moment, and we're growing our share all the time. So even though the category has been in decline and hopefully stabilising a bit going forward, we have been driving market share increases and still growing our business significantly. So I still see, and the rest of our team, we still see a significant share gain opportunity in infant in China, but we're also looking at expanding into adjacent categories over time. So fortified milk powders for kids and seniors are high growth opportunities for us. We also export UHT and liquid milk to China. And we're going to take those products and explore opportunities in Southeast Asia as well. So we're already in South Korea. And in this half, the half that's just been, we entered the Vietnam market, which is a great opportunity for us. It's actually a smaller version of the China market. There's over 1 million births in Vietnam, and in many ways it's similar to China because they use the product for an extended period. The competitive set is similar, and the distribution channels are similar in some ways as well. So we're really excited about the Vietnam opportunity, and then maybe over time there's more in Southeast Asia and the Middle East as well.
That's Rhayna Bosch there, speaking with the CEO of the A2 Milk Company, David Bortolussi. Now, Market Day on the SBS On The Money podcast. Ahead of that rate decision, the Reserve Bank decision coming out on Tuesday. The ASX 200 down today, though, 0.2% to 8,537. With the details, I spoke with Luke McMillan. He's the head of research at Ophir Asset Management. Luke, first of all, to what extent is the market expecting the Reserve Bank will cut interest rates tomorrow?
Yeah, it's certainly a pretty high probability. You know, call it 85-90% probability is what the markets are pricing. Wind the clock back to the early part of this month, and it was closer to 100%. I think the economists are kind of trying to sway the market and say it's closer. It's a closer call than many think. But you know, softer recent quarterly CPI data, more dovish speak from the head of the RBA back in December, I think makes it more likely than not that they cut tomorrow.
So if they do cut, what's the likely implication for markets and currencies?
Well, I think the market's expecting a cut. So I think, you know, the shock reaction would be either that they don't cut or that they cut and give some hawkish commentary around the next move, because the market has 3 cuts priced in for this year. So anything that kind of walks that back would be a bit of a surprise to the market. And anything that is a beneficiary of rate cuts probably would feel the brunt of that more. And so that's, you know, housing exposed stocks like, you know, realestate.com and Domain, and some of the consumer goods companies that go along with that, maybe like, you know, Nick Scali, JB Hi-Fi, etc., would probably feel that the most if either they don't cut or it's a cut, but then hawkish commentary.
Profit reporting season follows today. The banks were smashed. It follows results from Bendigo and Westpac. What was in there that investors didn't like?
Yeah, the Westpac result certainly wasn't as bad as the Bendigo result, and that's reflected in, you know, the share price movements, with Westpac being down as we speak around more sort of the 4 or 5%, and Bendigo being down more around kind of 16%. It was the net interest margin for Westpac that was of most concern for investors, but for Bendigo Bank, it was really kind of misses across the board in terms of revenue, profits, and also net interest margin, and, you know, dividends disappointed versus expectations, and so that's why you saw the outsized move there. You know, interesting, you know, fact: Bendigo Bank over the last year has actually outperformed from a price perspective at Commonwealth Bank. That is no longer the case after today's share price movement. So I think, you know, just both those stocks had really quite a strong run, you know, up over 45% over the last year into these results, and, you know, a bit softer than expected, and the market's taken to them pretty harshly.
Any other company news you're following today?
Yeah, probably one of the other big ones that we've seen so far today is A2 Milk, which is up very strongly, you know, kind of between 15 and 20%. It's been up today. Really a lot of strength across the board, both, you know, really at all levels of its profit and loss statement, beating market expectations, whether you're looking at, you know, revenues, gross margins, profit. You know, it's a top 5 brand in China infant milk formula market. It is in the top 3 in terms of market share gains at the moment. Its Chinese, you know, business is coming back to life, and even in its kind of relatively more boring, you know, Australian adult milk business, actually saw double-digit revenue gains, half on half, so up about 11%. So pretty good news all around for A2.
One of the big stories last week was that of Chemist Warehouse kind of finding a backdoor entrance into the ASX by, I guess, a reverse takeover of Sigma, right? How's Sigma been going on?
Yeah, great. Up 20%. Really, I think over the last 3 sessions, its market cap now is about the same as Woolworths. So pretty incredible there. Obviously, some people thinking that, you know, some of the franchisees might be selling out, but so far in that war of fund manager and index buying, they're winning certainly over any franchisees getting out in terms of moving the share price.
And just back on profit reporting season, you know, we're well and truly into it now here in Australia. Are you sensing or are you seeing any types of themes at the moment?
Yeah, I mean, generally it's been a pretty good so far reporting season. We're about a third of the way through the ASX 200 in terms of reporting. Normally you see an average downgrade in aggregate ASX 200 profits for the next 6 months of about 0.7%. So far that's tracking down about 0.2%. So yes, there's some downgrades, but it's actually a little bit better than normal. In terms of what we've seen so far, I'd probably say that, you know, for some of the consumer and consumer retail exposed stocks, it's been pretty good in general so far. You know, whether you look at that in terms of JB Hi-Fi, Temple & Webster, it's looking so good so far. And, you know, that bodes pretty well for, you know, if we do get the RBA coming through with, you know, its first rate cut this cycle tomorrow, as I think that's likely to just help underpin some of those trading updates that those consumer and retail exposed stocks have provided for, you know, what is effectively kind of the first 6 weeks of trading so far this year.
And finally, where do you see the opportunities for investors at the moment?
Yeah, I do think part of it, you know, is in some of those stocks that are going to be beneficiaries from lower interest rates. You know, ourselves, you know, have supporters and like where realestate.com's positioned. We also like Breville Group, where they're positioned in terms of consumer goods. And probably in a less macro-related area, just a more structural growth opportunity. We like the Business Generation Development Group. And so that for those that know that business, its CEO is Grant Hackett, the ex-Olympian. They recently took out and acquired the whole of the business of Lonsec, which is a rating house here in Australia. And that business just bought its next biggest competitor, Evidentia, which is essentially putting together investment-related products for financial advisors in Australia. And we think that's a theme that's going to play out over the next sort of 5 or 10 years.
That's Luke McMillan there from Ophir Asset Management. Don't forget, if you enjoy the podcast, to give it a rating on Apple Podcasts or Spotify and to click that subscribe button. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial